Perfect, friends. So I'm starting off with today's session. Good evening, everyone. As I had promised earlier, I am live from today, every day night at 9 p.m. to 11 p.m. 2 hours so that we can discuss and we can, revise the RTP and MTP of Inter FM. All right. So today I'll start with RTP and we will do 2 hours. We'll not do too much. In 2 hours, we'll try finishing maximum. Whatever is pending again tomorrow. So you can also schedule your plan in a way that you also get exactly 9 p.m. to 11 p.m. 2 hours slot to complete your revision time. All right, friends. So let us start off today with the RTP. I'm sharing my screen. Let me just take the RTP. Yes. November 2023. Perfect, friends. So shall we start off? Are you all ready? Yes. So friends, we will do these problems and along with the problems, I will go on explaining to you the logic of these problems also. All right. Yes, perfect. So friends, first question is a question on ratio analysis. Now friends, even before I start with this chapter of ratio analysis, there are a lot of ratios for you to learn in this chapter of ratio analysis. And in order to learn these ratios, you might find it a little difficult to by heart all the formulas. I strongly recommend understand the logic so that once the logic is clear to all of you, then all these conceptual areas will become very much easy for all of you. So I'll just write down over here Inter FM Rtp. All right. So for example, I'll just give a very simple example. If you talk about current ratio, what is the formula for current ratio? It is going to be current assets divided by current liabilities. So friends, whatever comes in the denominator is always mentioned in a unit of 1 rupee or 1 unit. And this one is, let us say, 2 rupees. So 2 divided by 1, what is the answer that you get over here? Do you get the answer as 2 rupees? Or the logic is for every 1 rupee of current liability, my current assets is how much rupees? 2 rupees. So always keep this in mind. Whatever is the denominator in normal scenario will be the base. That we take it as 1. So if denominator is 1, what is the numerator? This is one way of how, the entire ratio analysis chapter is actually explained. All right. Now, considering this, let us go through this question. I will give you a minute's time. Can you please read through the question and understand the question? All right. So here what they have done is they are actually giving you the current ratio of the previous year and then they are giving you the ratios of the current year and then they are giving you the average of the industry. Then they are asking us whether it is good or whether it is bad. It's a very easy problem and it is more of a logic driven area. All right. So what I will do is I will just take my pen and we will start discussing this part. Please interact with me. All right. Here, how much is the current ratio? 2.1. 2022, it becomes how much? 2.3. So my question to you is 2.1 means what? For every 1 rupee of current liability, last year there was 2.1 rupee of current assets. This year, for every 1 rupee of current liability, you have 2.3 rupees of current assets. So which is better, friends? 2.1 or 2.3? 2.3 is better. So has the company become better or has the company not become better? The company has become better. Are you all clear with this part? But what is the industry average? 2.4. So are they able to achieve the industry average? The answer is no. Everybody clear? So how we are supposed to write over here is, we will write down as follows. I'll just clear this up and I'll write down over here. Point number A. Current ratio has improved. I'll give the question number. We are doing question number 1. Has improved from 2.1 to 2.3, which is a positive sign. However, the industry average is, what is the industry average? Everyone tell me. 2.4. Hence, the company can perform better. All right. Can you just write down this quickly in your books? Friends, these notes, I will share it with you. All right. So if you just have to write along with me, because if I give you too much time to write down, we may not be able to complete this RTP marathon. But these handwritten notes will be given to all of you at the end of the class every day. So you all can directly view it. Okay. It will be shared in the WhatsApp group. All right. I believe you are all done with this part. Now, once you're clear with the logic of the first one, now let us do the second one. Even though I cannot hear you, I request all of you to please interact with me. It's okay if I cannot hear you. Speak over there. It's fine. But keep on talking, because that will give you the, you will become alert and you will learn it in the class itself. Quick ratio 1.4. What is the logic of quick ratio? The logic is, for every 1 rupee of current liability, how much is my quick assets? What do you mean by quick assets? Liquid assets. So the assets that I can get very fast. So it's something assets excluding inventory, because normally our fund gets blocked where? Our fund gets blocked in inventory. So they are saying that last year, for every 1 rupee of current liability, we have 1.4 rupees of quick assets. This year it has become 1.8. Good or bad? Good. Very good. Compared to the industry average, good or bad? Good, even compared to the industry average. Everybody clear with this part? Next one is what we call it as the receivable turnover ratio. So the receivable turnover ratio is basically, the formula for receivable turnover ratio is sales divided by debtors. Okay, then that is what you call it as the receivable turnover ratio. So here it is 8 times, means your sundry debtors into 8 times is your turnover. Whereas here, your sundry debtors into 9 times is your turnover. Higher the turnover ratio, the better for the company. So tell me, 8 to 9, is it good or bad? It is good. All right. Industry average is 8. Better than the industry or worse than the industry? Better than the industry. Same way, inventory turnover ratio. Last year, the stock was turning 8 times. This year, the stock is turning 9 times. So is it better or not better? It is better. Industry is only 5. They are doing much better than the industry. Receivable collection period. Last year, they were collecting money in 46 days. This year, they are collecting money in 41 days. Good or bad? Good. Industry average is 46. Better than industry or worse than industry? Better than industry. Excellent, friends. I believe you are all clear with the concept now. Next one. Operating profitability. ROI, 24%. That means if anybody is investing 100 rupees in this business, they are getting back how much money? 24 rupees. That's what they call it as 24%. This year it's only 21. Good or bad? Bad, because the returns have started coming down. But when you compare with the industry average, is it good or bad? It is good enough. Everybody clear? Okay. Operating margin. Last year 18, this year 18. Exactly the same. No worries at all. But industry is only 12. So are they better than industry? Yes, they are better than the industry. Last one, debt ratio 45. Now it has become 44. Friends, debt ratio, we can never say whether it is good or whether it is bad. All right. Debt ratio is a personal choice. Some people prefer debt, they have more risk. Some people prefer equity, they have less risk. So don't say that, it's 45, 44, good or bad. Just say that last year debt ratio was 45. Now it has become 44. But industry wise, up to 60, it is acceptable. That's all. Never say one is good and the other one is bad. Everybody clear? Return on equity. Last year, 26%. This year, 28%. Good or bad? It is very, very good. What about the industry average is only 18? Is everybody clear with this part? I'll give you a minute's time. Just process this information. Then we will go to the next part. Perfect. So I believe we are done with this question. Can I go to the next question now? Okay. Perfect. Okay. So now next question is on cost of capital. Friends, in the exam, whenever you get a question, we can work it out in three particular steps. Step number one is called as basic data. Why basic data? Because we need to understand the question. After that, we do analysis and we go to conclusion. All right. So I will take question number two. Working note number one, basic data. Jason Limited is planning to raise additional finance of 20 lakhs. So point number A, additional fund needed. How much is the additional fund needed? It is 20 lakhs. All right. It has 4.2 lakhs in retained earnings. So I'll write down retained earnings. How much is the retained earnings? 4 lakh 20,000. Point number C, down they have given the further details. Friends, even though they have provided a table, it's always good to write it down once. Why to write down? So that your brain can understand the question. Once you can understand the question, answers will come automatically, friends. So our focus should not be on just getting the answer. Our effort in the examination hall has to be to understand the question. So they have given the debt equity ratio as 30:70. So I'll write down over here debt equity 30:70. That means debt is 30, equity is 70. Cost of debt up to 3 lakh 60 is 8%. So I'll write down KD up to 3 lakh 60,000 is 8% is before tax. So how much will that become after tax? Can you tell me? What's the tax rate? 40%. So what is 8 into 1 minus 40%? Do you get the answer as 4.8%? Correct? And what is the KD beyond 3,60,000? KD beyond 3,60,000 is what? 12 into 0.6. That is equal to how much? 7.20 percentage. All right. Now EPS. What is the EPS that you have over here? 4 rupees is your EPS. Earnings per share is given. Dividend is 50% of earnings. So DPS will turn out to be how much? 2 rupees. How did I get that? 50% of 4 rupees is going to be your DPS. Friends, normally, okay, let's check how your textbooks have solved it. This is if earnings per share is based on the audited financials, dividend payout will also be from financials. So that will be treated as D0. This will be your E0, okay, because it is from your audited financial statement. So if it's coming from AFS, it's going to be E0. Are you all clear with this part? D0 is how much? 2 rupees. Next part. Current market price is given as 44. Market price is 44. Expected growth rate in dividend, the G is turning out to be how much percentage? 10% is the growth. All right. And tax rate is given as how much? HIJ tax rate is 40%. So here we have put up the basic data. We have understood the question. Let us repeat and understand this question. Extra funding required is how much? 20 lakhs. Out of that retained already we have 4 lakh 20. Debt equity ratio 3:7. KD is 4.8 up to 1.7.2. Beyond that, EPS is given, DPS is given, MPS is also given, growth is also given over here. All right. From this data, we can find out some hidden information. So I'll write down working note number 2, analysis. Okay. Point number 1, total how much fund is required. I'll write down Roman number 1, analysis of funds. Now tell me, total how much funds are required? 20 lakhs. Now this will be done in the ratio of 30% debt, 70% equity. Am I right? So I'll put equity over here. And this is going to be debt. Now tell me how much is 20 lakh into 30%? Do you get the answer as 6 lakhs? 20 lakh into 70% will be how much? 14 lakhs. Am I right? All right. Now the 6 lakh, they have told up to 3.60 lakhs, they have to pay an interest of how much? Or what is the KD that you have after tax? 4.80%. Correct? Beyond that will be how much money then? 2 lakh 40,000. For the, how did I get this 2 lakh 40,000? 6 lakhs minus 3 lakh 60. On that, your KD after tax will turn out to be 7.20%. Whereas out of this total of equity, they already have some retained earnings. How much is their retained earnings? Everyone tell me. Is it turning out to be 4,20,000? Correct? And what is going to be the balance? 14 minus 4.2. Balance equity will turn out to be how much? 9.80 lakhs. Are you all clear with the concept? I'll give you a minute. You can draw this diagram or chart so that you understand this part very much clearly. All right, friends. Can I go to the next part now? So once you get the analysis of the fund, Roman number 2, we can actually find out KE. We know the formula P0 is equal to D1 divided by KE minus G. In this question, we have D0 2 rupees and growth is 10%. So that will be 2 rupee plus 10% divided by KE minus 10% should give you the market price. What is the market price that you will get over here? Do you get the market price as 44 rupees per share? Correct? So if I do a backward working, you will get 2.20 divided by 44 is equal to KE minus 10%. So 5% is equal to KE minus 10%. Therefore, KE will turn out to be how much, friends? KE will turn out to be 15%. Everybody clear with this part? I'll give you a minute. Please scribble down. Okay. So once you get KE, now we have got the analysis of the entire funding. We got KE. Next, we have to go and find out what? We have to find out KD. Now, friends, what is happening for KD is 3,60,000 divided by total debt will be how much? 6 lakhs, correct? For this, the after-tax KD that we found out is how much? 4.80%. Along with this, 2,40,000 divided by 6 lakhs, that is a second slot, multiplied by how much was the KD for the second slot? Was it 7.2%? Right? So once I do like this, I will get the weighted average KD. So now tell me, how much is 3,60,000 divided by 6 lakhs into 4.8? That will be 2.88% plus, again you get 2.88%. So when you add up these two things, do you get the answer as 5.76% friends? Yes, please scribble down. I hope you're all clear so far. So we did KE, we did KD. We just made a pattern of how the entire thing is going to happen. Am I right? Excellent. Perfect. So once you get this, then I will go to the next part where we need to go and find out the weighted average cost of capital. That is KE into weight of equity plus KD into weight of debt. So how much is KE that you have? 15% into 70% is the weight plus KD is how much? 5.76 into 0.30. You get the answer as 12.228%. With this, we are done with this question. I'll give you 1 minute time, write down and understand the entire thing. Perfect. Can I go to the next part now? Are you all clear with this part? Okay, Anjana, you have a doubt. Cost of retained earnings is same as cost of equity. Anjana, always cost of equity and cost of retained earnings has to be the same. It should not be different because retained earnings is whose money? It is the equity holders' money only, right? It should be the same. In your books, they have created a confusion because they have, given two formulas, but both give you the same answer. If you come across any question where you get a different answer, let me know. I think one illustration has created that confusion in the FM study materials. Perfect. Can I go to the next part now? Yes, Jwala, one very good point. If there is a flotation cost, see, when you have a flotation cost, that is a cash outflow. Am I right? So when you have a cash outflow happening, we should consider what is our cash flow that is coming over there. If you're going for additional equity, this additional equity has got a clear-cut flotation cost, then it will have a separate KE. But if your equity is your existing equity and your retained earnings are also existing, then both will exactly be the same. Are you clear, Jwala? Focus on the cash flow. What is the cash flow that is relevant to you? So flotation cost becomes an outflow, so you can reduce it. Okay. Yes. I believe we are all done with this part. Can I go to the next one? Yes. Next question, question number 3. Okay. So here they have given a P&L account. We will draw the same thing. Question number 3. Working note number 1. Basic data. Point number A, EBIT. How much is the EBIT they have told over here? 3 lakhs. Notes I'll share with all of you, okay? Less interest. How much is the interest that you have? 50,000. So once you reduce this, what will be your earnings before tax? 2 lakh. 50,000 less tax. So here tax will turn out to be 1,25,000. So once you do that, you get the profit after tax. How much is that turning out to be? 1,25,000. What is the number of shares that you have with you? 25,000 shares. So you get the answer as 5 rupee per share. All right. Then you have PE ratio. How much is the PE ratio that you have? 10 times. 50 rupees per share will then be your MPS. So we have got our basic data in one place. But basic data is not over. We have more. Now they have told they are having reserves and surplus of how much? 7,50,000. Okay, what else have they told over here? And they require 5 lakh further additional fund needed. They need additional funds of 5 lakhs further for modernization. ROCE is constant. So I'll write down that also as a point here. So as of now, whatever is the investment they have told, their ROCE is constant. Now they have told if the debt equity ratio is higher than 40%, then PE ratio will come down to 8 times and the interest will go up. So if, what have they told? If debt is greater than 40%, then P will be equal to how many times? 2 times. Same way, if debt is greater than 40%, then your interest will increase to how much percentage? 12% on the additional debts. They are asking you to find out the probable price of the share if additional capital is raised as debt or additional capital is raised by way of equity. Okay, let us just understand this question once again, friends. EBIT is how much? 3 lakhs. Interest, 50,000. EBT, 2,50,000. Tax, 1,25,000. Profit after tax is 1,25,000. You have 25,000 shares, so you get an EPS of 5 rupees per share. PE ratio is 10 times, so your market price per share will become how much? 50 rupees per share. Reserves is how much? 7,50,000. Additional funds will be 5 lakhs. ROCE is constant. Debt more than 40% will create 8 times PE ratio. Interest will become 12%. So now what they're trying to tell you is that this 5 lakh, you can raise it in 2 methodologies. One, either raise it by way of equity or you can raise it by way of debt. Everybody clear with this part? So we need to go and check which one is going to be better. But even before we do that, we need to find out certain things such as ROCE, which according to them is constant. How much is the ROCE? Have they told it over here? No, they haven't told it over here. So I believe we have to go and first find out what is the existing ROCE, right? Here, they have told equity shares is 10 rupee each. So wait, I'll write down working note number 2, analysis. In that Roman number 1, I would say ROCE is constant. All right, so return on capital employed is constant. So point number A, we need to find out the capital employed. That will consist of equity. It will consist of reserves. And it will consist of debt. Now tell me how much is the equity that they have told in the question. Let's go and check. Have they told 25,000 shares of 10 rupee? So will that turn out to be 2,50,000? Correct? Reserves. How much is the reserves they have told over here? Is it 7,50,000? That is given in the question over here. And have they told anything about the current debt? Yes, they have told interest on debenture is 50,000. So that would mean 50,000 divided by 10%. That will turn out to be 5 lakhs. So what is your total capital employed? Do you get the answer as 15 lakhs? Okay. Now, how much is your profit? I think for taking the ROCE, hold on. return on capital employed, we should consider the earnings available to both the people. So it will be taken as EBIT, that is given in the question. Earnings before interest and tax. How much is the earnings before interest and tax that is given over here? Is it 3 lakh? Therefore, your ROCE will turn out to be 3 divided by 15, which is equal to how much percentage? 20%. I'll give you a minute's time. Can you please scribble down this? Yes, Dharni, I'll do all that at the end of the class. Okay, I'll pack up my class by 10:45, 10:50. Last 10 minutes, I'll share all those things and I'll confirm that you all have got it. Then only I'll pack up my session. All right? Perfect. So I believe you're all clear with this part. Now, why I did this is because we can now, I'll write down Roman number 2, revised EBIT. Why I'm saying revised EBIT is because as of now, how much is your total capital employed that is given over here? Is it given as 15 lakhs is the total capital employed? Correct. Point number B, how much is the additional funds that are required? Will it turn out to be 5 lakhs? So what will be the total capital employed for the next session? That will be 20 lakh. They have told ROCE will remain constant. How much is the ROCE you have now? 20% of 20 lakhs. So tell me, what will be your new ROCE that you get over here? Will you get the answer as 4 lakhs, friends? Everybody clear? So that is the, sorry, that's not ROCE, that is your new EBIT. Bracket we can give as ROCE remains constant. Are you all clear with this part now? Okay, I'll give you a minute. Please write this down in your books. Perfect. Can I go to the next part now? So we are done with revised EBIT. Now, what are they asking? That this extra money can be taken either by way of debt or it can be taken by way of equity. So let's do it. So I'll write down Roman number 3, analysis of profits. Okay. Particulars. We have situation 1 where it is taken as debt, and then you have situation 2 where it can be taken as equity. All right. So first I will write down EBIT. How much is going to be the EBIT now, friends, in both the scenarios? Will you get the number as 4 lakhs? Now, what will be point number B? Less interest. Now, friends, if this extra 5 lakhs is taken as debt, all right, how much will be the interest that will come on that? We need to work it out. See, if you take that 5 lakh as debt, already how much debt are you having over here? Already we are having a debt of 5 lakhs as of now, correct? So as of now, our debt equity ratio, I'll just write down and just explain to you. As of now, it is 5 by 15. 33.33% is the current debt equity ratio. Later on, it will become 10 by 20. Extra 5 will come as loan. Denominator will also go up. So if you do 10 by 20, your debt equity ratio will become how much? 50%. If it becomes 50%, they have told it is going above 40%. Am I right? If it goes above 40%, what will happen to the additional interest? Will it remain the same or will it change? Now the additional interest will become 12%. Am I right? So what will happen is here we already have 50,000 of existing interest plus on 5 lakh, it will be 12%. That will be 60,000. So total, you will get the answer as 1 lakh 10,000. Whereas here, you will have 50,000. Everybody clear? So once you do this, you will get the earnings before tax. So what is the earnings before tax that you get over here? Do you get the answer as 2 lakh 90,000? Whereas here it will be 3 lakh 50,000. All right. So once you get the earnings before tax as 2 lakh 90,000 and 3 lakh 50,000, from this, what are we going to do? We will reduce the tax. Okay. Now tell me, how much is the tax that we have over here? 50%. 1 lakh 45,000. 1 lakh 75,000. Okay. So once you do this, you will get the profit after tax. 1 lakh 45,000. 1 lakh 75,000. Now I have to put the number of shares. If you take it as debt, there is no problem at all because you have as of now how many shares with you? 25,000 shares. But if you take it as equity, you have 25,000 shares plus how much new funding is required by them? 5 lakh is required by them. And what is the market price that we got? 5 into 10, 50 rupees, correct? So how much extra shares will come? 5 lakh into 50 will be, if I'm not wrong, another 10,000 shares, is it? Just confirm. Yes, another 10,000 shares. So you will get the total as 35,000 shares. So now tell me, how much is 1,45,000 divided by 25,000? Do you get the answer as 5.80 rupees per share? What about the second one? You will get 5 rupees per share. Correct? I'll just come and write down over here. So this will be the EPS. They have also told the PE ratio. If the debt goes up, your PE ratio will become 8 times. Here the debt doesn't go up, so your PE ratio will remain at how much? 10 times. So 5.8 into 8 times will be how much? 46.4 rupees per share. And here it is 50 rupees per share. So tell me, friends, which one is better? 46 is better or 50 is better? This is better. I'll give you a minute's time. Can you please understand this part? If you have any doubts, please ask me now. Perfect. Can I go to the next part now? Are you all clear with how this entire thing has come? We can just give one additional note below. If debt increases to 10 lakhs, then debt equity ratio will become 10 by 20. That is equal to how much percentage? 50%. In this case, PE ratio will come down to 8 times, and interest on additional debt will be how much, friends? 12%. Okay. So with this, we are done with question number 3 also. Are you all clear with this part, friends? Can I go to the next one? Perfect. I will go to the next question now. That is question number 3 is over. Let us do question number 4. 4 is a question on leverage. So I'll write down question number 4. Working note number 1. Basic data. Point number A. Equity capital is given as 20 lakhs. That is, how much is the face value? 100 rupees, correct? So it will be 20,000 shares into 100 rupees is equal to 20 lakhs. Everybody clear? Next one. 10% debentures. 10% debentures is another 20 lakhs. That will again be 20,000 debenture into 100 rupees will be 20 lakhs. From this, I can find out the total capital employed. How much will be the total capital employed? Do you get the answer as 40 lakhs? Okay. Now they have told during the year 2021, sales decreased to 1 lakh units as compared to 1,20,000 units. So sales has come down. Sales in 21, 22 is 1 lakh units as compared to 1,20,000 units. All right. However, the selling price stood at 15 rupees. Variable cost was 10 rupees. Variable cost is how much? 10 rupees per unit. Fixed expenses 2 lakhs per annum. Two lakhs per annum, and the income tax rate is how much percentage? 30%. I'll give you a minute, scribble down, understand the basic data. Yes, Anjana, this question is there in your material. Many more questions also will be there in your material, Anjana, because the focus was on the past question papers. All right. So friends, here equity is given, debt is given, last year sale, current year sale, selling price, variable cost, fixed cost. So basically, from this statement, can I prepare a profitability statement? So I will write down working note number 2, analysis. In this, I will write down Roman number 1, leverage. Sorry, not leverage, income statement. Income statement. We can do this for 2021. And what is the other one? 21, 22, and 2021, correct? '21, 22. Okay. Point number A, I will put sales. So they have told sales units. The last year, I think they had 1,20,000. This year, they are having 1 lakh, correct? And we know the selling price also. What's the selling price? 15 rupees. From this, can I find out the sale value? So what will be 1.2 into 15? I think you will get the answer as 18 lakhs, correct? And here 15 rupees would be 15 lakhs. What about the variable cost? 10 rupees. So that will be 12 lakhs, 10 lakhs. All right. From this, what will be your contribution that you will get over here? 6 lakhs. And here it will be 5 lakhs. Correct. So we got the sale value, we got the variable cost, we have the contribution. Next will what? Next come will be what? Fixed cost. So what is the fixed cost that you have over here? 2 lakhs. 2 lakhs. All right. So once you take the fixed cost also, then you will get the EBIT. That will be 4 lakhs and here it will be 3 lakhs. Next will come what? EFG. After this, we'll put the interest. So how much will be the interest over here? 20 lakh into 10 percentage. 2 lakhs. Then you have 2 lakhs, correct? And then from this, I will get earnings before tax. That is 2 lakhs and 1 lakh. Once you get this, then we can put the taxation. Have they told anything about the taxation over here? Okay. For time being, nothing has been given. So I'll take it as, I don't think this is relevant in that case. We'll just keep it this way. Okay. Can you please scribble down this in your books? Have they given the tax rate given as 30%? So sorry, I have missed it out then. Where is it given? Oh, it's given here. So let's put the tax rate also in that case. Tax rate is 30%. So that will be 60,000 here. And here it will be 30,000. All right. So once you do this, I will be getting the profit after tax. That will be 1,40,000. And here it will be 70,000. We also have the number of shares. What's the number of shares? I think we found out that to be 20,000 shares, correct? So what is going to be your EPS? 1,40,000 divided by 20,000. Do you get the answer as 7 rupees per share? And do you get the answer as 3.5 rupees per share? Yes. Perfect. So I think we are done with the first part. Now they're asking us to find out the financial leverage and operating leverage. Okay, I'll do it here itself. What is the formula for operating leverage? It will be contribution divided by EBIT. So how much is the contribution that you have? 6 lakhs divided by 4 lakh. Do you get the answer as 1.5 for the first one? What about the second one? 5 lakh divided by 3 lakh. Do you get the answer as 1.67? Next, what will we find out over here? Financial leverage. So now tell me, what is the formula for financial leverage? EBIT divided by EBT. That will be 4 lakh divided by 2 lakh. So you get the answer as 2 and the other one will be 3. 3 times. All right. Yes. So we are done with the operating leverage and the financial leverage over here. Perfect. I'll give you a minute's time. Write down and finish it off so that we can go to the next question. Okay, friends. So I think we are done with this. Can I go to the next one now? Excellent. Let me go to the next part. All right. Fine. So we are done with this question also. Oh, they are asking one more thing, percentage change in EPS. That we can find out here itself. How much is the percentage change in EPS, friends? 7 has become 3.5. So it is falling by 3.5. So can I say there is a 50% fall that has happened in the EPS? Correct? Percentage fall will be 50%. Okay, right. So we are done with that question also. Next question is a question on investment decision. It's a capital budgeting question. Let us do that. Working note number 1. What is the question number? Question number 5. Working note number 1, basic data. Okay. PQR is considering buying a new machine which could have a useful life of 5 years. So life, how many years? 5 years. Okay. Point number B, cost is how much? 40 lakhs. 40 lakhs. All right. Scrap value is how much? 5 lakhs. Okay, friends, from this, can I immediately find out the depreciation? 40 minus 5 is 35. 35 divided by 5 years. Do you get the answer as 7 lakhs over here? That will be your depreciation. Okay. Next one. With 80% of the cost being payable at the start of the project, 20% at the end of the first year. So 80% payable in year 0. 20% payable in year 1. All right, what next? Down they have, after that, what have they told? Machine would produce 80,000 units of a new product. So I'll write down units. That will be 80,000 units. All right, EFGH. Next point of the new product with a selling price of 400 rupees. 400 rupees per unit, and the direct cost would be 375 rupees per unit. ₹375 per unit. Annual fixed cost including depreciation would be 10,40,000. So annual fixed cost including depreciation is how much? 10,40,000. So can we find out how much is HIJK? Fixed cost excluding depreciation. That will be 10,40,000 minus 7 lakhs. Do you get the answer as 3,40,000 rupees over here? Correct? Yes. In the first and second year, they will have some special sales promotion. That will be 1,25,000, 1,75,000. Then I'll write down special sales promotion. $1,25,000. This is going to come in year 0. Am I right? Sorry, first year. So it will be year 1. Year 1. Special sales promo. Year 2. Okay. Evaluate the project using NPV. So that's it. They have given the discounting factor as how much? Discounting factor is 12%. Friends, whenever you do a question on capital budgeting, first thing that you are supposed to do is put the whole data and determine which year these cash flows are happening. For example, this cash flow will happen in year 0. Correct? What is the total life? 5 years. Scrap value will happen in which year? Year 5. Depreciation will happen from year 1 to year 5. Okay? This is year 0, year 1. This units will be year 1 to 5. Selling price 1 to 5. Direct cost 1 to 5. This will be 1 to 5. This will also be 1 to 5. This will be year 1 already written. This will be year 2. So once you break it up like this, it becomes very easy for you to go and do the calculations. All right. So now based on this, what I will do is I will write down Working note number 2, initial cash outlay. Initial cash outlay, that is year 0. Now tell me what and all will happen in year 0. First one will be the cost of the machine. How much is the cost of the machine? Do you get the answer as 40 lakhs? All right. Down when you come, they have told 80% is payable in year 0 out of the 40 lakhs. So entire 40 lakhs will not come in year 0. Of this 40 lakh, only how much will come in year 0? 80%. That is 32 lakhs. Balance 20% is going to happen in which year? Year 1 that will happen. So we will consider that separately. All right. Depreciation, this. Anything else coming in year 0? Nothing else is coming in year 0. Okay. Then I'll write down the next working note. Year 1 cash flow. Okay. Year 1 cash flow. So when you do year 1 cash flow, in this I'll write down point number A. 20% is payable. So how much is 40 lakh into 20 percentage? You are going to pay 8 lakhs. All right. That is point number 1. Next one, what they are saying over here is special sales promotion will come 1,25,000. 1.25 lakhs. Apart from that, whatever comes from year 1 to 5 will also come over here. Selling price 400 minus 375. So I'll put over here, okay, yearly profit. That will be 400 minus 375. 400 minus 375 into what's the number of units that you have over here? 80,000 units. Into 80,000 units minus fixed cost is how much? 10 lakh 40,000. You get the answer as 9 lakh 60,000 rupees is what you will get over here. Am I right? 9 lakh 60,000. Is there any tax rate that they have told in the question? Tax rate has not been told. So including depreciation, we get the amount as one moment. Tax is not mentioned, right? Not mentioned. All right. So you get 9 lakh 60,000. That is after reducing depreciation. I'll add back the depreciation now. How much is the depreciation that we have? Is it 7 lakhs? Add back 7 lakhs. So you get the answer as 11 lakh, not 11 lakh, sorry, 16 lakh 60,000. Yes. I'll give you a minute's time. Write down this and process this information. I will also cross-check if I have missed out anything over here. 8 lakh we have taken. 1 lakh 25 has been taken. Contribution is going to be 25 into 80,000. That is 20 lakh minus 3 lakh 40,000. That is 16 lakh 60,000. Correct. So if I put it this way, how much will be my cash flow for year 1? Cash flow for year 1, that will be 8 plus 1.25. These are two outflows, correct? Okay, so I'll put the inflow first. So that will be 16.60 minus 8 lakh minus 1.25 lakh. Do you get the answer as 7 lakh 35,000? 7 lakh 35,000. I'll give you a minute's time. Please process this. Fine, friends. I believe you're all done with this part. Then I'll write down working note number 4. Let me go and find out what is your year 2 cash flow now. All right. So year 2, what is happening? Let's go and check now. Year 2, I think what else will come? Only the special sales promotion will come, correct? So first I'll write down yearly profit. Yearly profit. How much is the yearly profit? 16 lakh, 60,000. Point number B will be what? Special promo. That is 1 lakh 75,000. So once I reduce this, what will be my cash flow in year 2? Do you get the answer as 14 lakh 85,000? Am I right? Okay. So once you get this, I will put working note number 5. After you get year 2 cash flow, then it is year 3 to year 5 cash flow. That will be 16 lakh 60,000. And final one would be, sorry friends, final one would be your terminal cash flow. So at the end of the period, what will happen? You will get your salvage value. How much will you get back? You will get 5 lakh rupees. Everybody clear? Perfect. So that's it. So once I think what we will do is we'll put this as year 3 to year 4. Year 3 to year 4. And this will be 5 lakh plus 16 lakh 60,000. So that will be 21 lakh 60,000. Once we do this, we can go and now find out our NPV. So I'll write down working note number 7, NPV. Year, cash flow, discount factor, discounted cash flow. Now tell me, what is the discounting factor told in the question? Is it 12%? All right. So now tell me, year 0, what is the amount that comes over here? Is it 32 lakhs? I'll write down. Year 0, 32. Year 1, it is going to be 7 lakh 35,000. Year 1, 7 lakh 35 is going to be my inflow, correct? Yes, 7 lakh 35. Year 2, my inflow is going to be 14 lakh 85,000. Correct. Year 3, 16 lakh 60. Year 4, 16 lakh 60. Year 5, it will be 21 lakh 60,000. All right. So now we have to do using a discount factor of year 0 will be 1, 0.89, 0.797, 711, 0.635, 0.567. So if you do this multiplication, you will get minus 32, 6.54, 11.835, 11.80, 10.54, 12.24. Then you get 20.955 lakhs. That is going to be your NPV. So NPV is positive or negative? NPV is positive. Hence, we should accept the project. All right. I believe you are all done with this part. Can I go to the next one now? Excellent. So we are done with the question on capital budgeting also. Next one is a question on working capital management. Friends, it's a little lengthy and a complex problem. We will do this tomorrow fresh at 9 o'clock. All right. Let me cover the remaining problems which are easy and which can get over faster so that we don't have to waste our time on that one question. And if we get time today, we'll do that today itself. But let me do the other easier ones first. Okay. Question number 7, risk analysis. So here I'll write working note number 1, basic data. All right. An enterprise is investing 200 lakhs. So here, the investments are turning out to be 200 lakhs. RF is how much? 7%. Risk premium is another 7%. So friends, basic RF is 7. Normally, risk premium is what we find out using the formula beta into RM minus RF. All right. So that's given as 7%. Therefore, your RADR over here will turn out to be how much percentage? 14%. Okay. Down they have told life is how many years? 5 years. I'll write down life 5 years. Okay. What else have they given? They have given the cash flow and they have given the year. And in which they're asking you to find out the NPV. It's such an easy problem, friends. I'll do it here itself. Working note number 2, NPV, year, cash flow, discount factor, discounted cash flow. Okay. So year 1 to 5 is given, right? Year 0, 1, 2, 3, 4, 5. Cash flow is given as 50. Sorry, year 0, what is the cash flow? It is 200. Year 1 is how much? 50. Then you have 120, 150, 160, and what is the last one? 130. Discounting factor is how much percentage? 14%. Okay. Now, 1.877, 0.769, 0.674, 0.592, 0.519. 43.85, 92.28, 101.11, 94.72. The last one is going to be 67.47. $399 minus 200. So I think you get the answer as plus 199.43 lakhs. So tell me, is the NPV positive or negative? Positive. Hence, what are we supposed to do? We are supposed to accept the project. All right. Is everybody clear with this part? Yes. Now let me just read the question. Calculate the NPV based on risk-free and also RADR. So they want you to find out the NPV if the discount factor is 7%. So I'll do that also. Working note number 3, NPV if discount factor is how much percentage? 7%. Okay, so here it will be year 0, 200 lakhs. Year 1, 50 lakhs. 120, 150, 160. 130. 0.9345, 0.873, 0.816, 0.762, and last one is 0.712. So here you get minus 200. Here you get 46.725. Here you get 104.76. 122.40. 121.92. 92.56. You get the answer as plus 288 lakhs. Again, your NPV even here is positive. But if you see the NPV is much higher, it's turning out to be a very, very high number. All right, I'll give you a minute's time. Can you just write down this and finish it off? So we are done with question number 7. Fine, friends. Can I go to the next part now? Yes. We are going at the right pace. 7 is over. Question number 8 is a question on dividend decisions. Question number 8. Working note number 1. Basic data. Point number A. HM is listed on the Bombay Stock Exchange, which is currently being evaluated by Mr. A. He has got the following information. Generally gives a quarterly interim dividend of 2.5 per share in the last year. D1 or D0? D0. So D0 will be 2.5 into 4 quarters. So do you get the answer as 10 rupees per share? Okay. Point number B. The company's sales are growing at 20%. So sales are growing at 20% on a 5-year CAGR basis. However, the company expects the following retention amounts against probabilities mentioned as given below. ROE, rate of return, is how much? 10%. This is what we call it as R. Okay. Down when you go, they have given you some retention ratios. 50 having a 0.3 probability, 60 having a 0.4 probability, and 50 having a 0.3 probability. Overall, average retention ratio you get is 54%. Average retention ratio is equal to 54%. Friends, from these two data, can I find out the growth? What is the formula for growth? BR, or retention ratio into rate of return. So it will be 54 into 10%. Do you get the answer as 5.4%? Okay. Current RF is 3.75%. RF is 3.75%. Beta is 1.2. Beta is 1.2, and risk premium is 4.25%. So from this, can I find out my KE that can be found using the CAPM return? RF plus beta into RM minus RF. So what's the answer you get over here? 1.2 into 4.25 plus 3.75. Do you get the answer as 8.85%? So friends, once you get this, I can finish off the answer here itself. I'm not going to the next page. I will write down working note number 2, price. What is the formula for price? P0 is equal to D1 divided by KE minus G. So what is the dividend that they have? 10 plus growth will give you D1 plus 5.4% divided by 8.85 minus 5.4%. Can you please do this and tell me what answer do you get over there? I think you will get the answer as 305.51. Friends, we got the price of this security also. I'll give you a minute's time. Can you write down this and finish it off? Question number 8 is also completed. So friends, we have covered almost the entire RTP in hardly 2 hours. Perfect, friends. Can I go to the next question now? Let's do question number 9. Yes, friends. Perfect. Let's go to question number 9. That is a question on working capital management and ratio analysis. So here we'll just put the basic data first and analyze the basic data. Working note number 1. Basic data. Point number A, sales. Everyone tell me what is the sales they have given over here. 105 lakhs. Point number B, GP ratio. What is the GP ratio? Is it 35%? Asset turnover ratio is 1.5. Fixed assets turnover. So FA turnover. What is the formula for that? It will be sales divided by fixed assets. Sale divided by fixed asset turnover is equal to how much? 1.5 times. What is the formula for GP ratio? GP divided by sales. All right. Here itself, we can find out one thing. We can find out the gross profit. Correct? Because we have the sales already. So how much is going to be 105 into 35%? Do you get the answer as 36.75 lakhs? Perfect. So we got the GP ratio. Once we get the GP ratio, next what we will do, we can also find out the fixed assets. They have told it is going to be 1.5 times. So we have the sales data. So fixed assets will be 105 lakhs divided by 1.5 times. Only then you will get the FA. Do you get the answer as 70 lakhs over here? Okay. So we found out two things. One, we found out the GP to be 36.75. 2, we found out the fixed assets to be how much? 70 lakhs. Okay. So once you get the gross profit, I can also find out the cost of goods sold. The next one, EF. Cost of goods sold will be sales 105 minus 36.75. That will be equal to 68.25 lakhs. All right, 68.25 lakhs. So once you get that 68, 1 minute. Hold on, have I made a mistake over here? Have they told that it's based on cost of goods sold? Thank you so much for correcting me. So in that case, what will happen is here we have to first find out 68.25. And then, so here the formula would be COGS divided by fixed assets. Thank you for correcting me there. So it wouldn't be 105 over here. It will turn out to be 68.25 lakhs divided by 1.5. If you do like that, do you get the answer as 45 lakh 50,000? Okay, I'll give you 1 minute time. Can you please scribble down till here in your books? Ratio analysis, we have to be very careful. Put correct data, then you see if there is some numbers, solve it there itself. Fine, friends. Can I go to the next page now? Okay. So I'll continue to the next part. So I think we got cost of goods sold as 68.25. Again, stock turnover 6 times. So stock turnover, formula is COGS divided by average stock is equal to 6 times, or in other words, 68.25 divided by 6 will give you your average stock. Do you get the answer as 11.375 lakhs? So we found one more thing. Whatever I find out, I will put it in yellow ink. Next one. After stock turn ratio, liquid ratio is 1.5:1. That is 1.5 divided by 1. Same way they have given below that. Current ratio is, if I'm not wrong, 2.5 divided by 1. Correct? So friends, normally, okay, we have got the average stock also over here. Let me see. Current liability is not given. Liquid ratio would be all the things other than inventory. Correct? So inventory, we have found out the answer as how much over here? Have we got the answer as 11.375? Yes. So in other words, what will happen is, therefore, inventory bar current liability will be 2.5 by 1 minus 1.5 by 1. That is nothing but 1 by 1. All right. So therefore, from this we can say that the current liability will be equal to the same as inventory, 11.375 lakhs. Once you get this answer, I'll go to the next part. Once you get the current liability, HIJ, then I can find out the current assets. How much will be my current assets in that case? 11.375 into 2.5 times. That is 28.4375 lakhs. Same way, I can also go and find out my liquid assets. Liquid assets will be 11.375 into 1.5 times. 17.0625 lakhs. Okay, I'll give you a minute's time. Please process this information. All right. So once we get the current assets and we get the liquid assets, next one is receivable collection period is 1 month. Receivable collection period is 1 month. That is what? Debtors divided by sales into 12 months is giving you the answer as 1 month. So we already know the sales figure. What is the sales figure? 105 lakhs. So sorry, it will be debtors divided by 105 into 12 is equal to 1. So if you put it this way, it will go on the other side. It will be 105 divided by 12, 8.75. Therefore, debtors will be equal to 8.75 lakhs. 8.75 lakhs. Okay. So once you get this, next one, we know the liquid assets is how much? We can find out the cash basically. Liquid assets was how much? 17.0625. From this, if I remove debtors, what remains will be only cash, minus 8.75 lakhs. So what is 17.0625 minus 8.75? Is it 8.3125 lakhs? That will be your cash. Ooh. Next one. Capital, okay, 1 minute. Reserves and surplus to share capital is 1:1.5. But I don't think they have given us anything about reserves and surplus so far. We'll keep that pending. Capital gearing ratio is 0.7875. Next one. Capital gearing ratio is 0.7875. Friends, capital gearing ratio means whatever is the debt to fund divided by equity fund. But again, for that, details are not available. We'll keep it pending. Fixed assets to net worth is given. FA divided by net worth is equal to how much? 1.30. We know the fixed assets. How much is that? 45.5 lakhs, correct? So I'll write down over here, therefore, 45.5 lakhs divided by net to worth is equal to 1.3. Therefore, your net worth will be equal to how much? 35 lakhs. So friends, what do you mean by the word net worth? There's equity plus reserves. All right. So once you get this, I'll go to the next page. Next heading will be P. So I think once you get that, they have told reserves and surplus to share capital is 1:1.5. Jwala, you have a doubt in stock. TOR is what? Stock turnover ratio. It's average stock. Current assets include only current inventory. Okay, fine. See, Jwala, here the assumption is that whatever is the average stock is basically that the opening and the closing are the same. That one assumption they are having because they haven't provided any other information. Okay, so that is why your average stock and your closing stock become one and the same. Are you clear, Jwala? Okay, right. Let me continue to the next part now. So I think now once you get this, reserves and surplus to share capital is 1:1.5. So I'll write down reserves and surplus to share capital is equal to 1:1.5. So it will be 1 divided by 1.5. So if share capital is 1.5, your reserves is going to be 1. Total we know. So total will be how much? 2.5. That is 35 lakhs. Therefore, reserves will be 35 lakhs divided by 2.5 into 1. You will get the answer as 14 lakhs. And your share capital will be 35 lakh divided by 2.5 into 1.5. So you get the answer as how much over here? 21 lakhs. 21 lakhs. Next one. Now we have capital gearing ratio that we can work out now. Okay. So what is the capital gearing ratio? 0.7875 is equal to whatever is your debt divided by your equity, that is 35 lakhs. So you get the answer as 27.5625 lakhs will be your debt. Perfect. So friends, once we get all these things, we just have to go and draw the balance sheet. I am not drawing the balance sheet now. I'll show you the solution so we can discuss and solve that part. It will take too much of time to draw the balance sheet. Okay, so I'll take the suggested answer. Yes, here. So we got the share capital 21, 14, long-term borrowings we got, current liability we got, fixed assets, inventory, trade capital, cash and cash equivalents. Your balance sheet will fully tally. Then they are asking you for the working capital requirement. Inventory, they need 11.37, debtors and cash. Total 28.43 lakh of fund is blocked minus 11.37 is the liability. So net working capital is 17 lakh. They have told put a contingency for 14%, that is 2.38. So altogether, they need a working capital of 19.45 lakh every year. I'll give you a minute's time. Please read through it and finish it off. Friends, I think we can finish off with the last question that they have kept pending. And today we can complete off the entire RTP November 23, friends. Shall we do that? Yes. So this was good speed, friends. In one day, we could cover the entire RTP. Let me take that one pending question now. Question number 6. Okay. So here they have told a regular customer has approached you for extension of credit facility. What is the question number? Question number 6. So there's a regular customer, okay? A customer wants extension of credit facility. All right. Now they have given a pattern. 20% normally from the past information. This fellow pays 20% within 30 days, 30% within 60 days, again 30% within 90 days, 18% within 100 days, and non-recovery will be how much? 2%. All right. Customer wants to enter into a firm commitment for purchase of 40 lakhs. So if customer is purchasing, what am I doing? Sell. So expected sales. That will be 40 lakhs. All right. And they have told deliveries to be made in equal quantities in the first day of each quarter. Selling price is 400 rupees per unit. So from this, can I find out what is going to be the total number of units? That will be 40 lakh divided by 400 rupees. Do you get the answer as 10,000 units? Correct? All right. 10,000 units. Next, I'll put it over here. 1 minute. It is anticipated that taking up the contract, they told they have a profit to be made is how much? 20 rupees. 20 rupees per unit. Therefore, what is going to be your cost over here? 380 rupees per unit is going to be your cost. Okay. It is anticipated that taking up of this contract would mean extra cost of how much? 20,000. So there is an extra cost that is 20,000 rupees. Opportunity cost is how much percentage? 18%. Point number H. Opportunity cost is equal to 18%. 1 year is equal to 360 days. Perfect. So we have put up the entire basic data. Sale value 40 lakh. Okay. Selling price 400 and units 10,000. Profit 20, cost 380 and extra cost 20,000. So they are first asking, should I give him an extension of credit facility? So let me go and find out the estimated profit first. Working note number 2 will be what? Estimated profit. Point number A will be sales. So what is the sales that you get over here? 40 lakhs. Point number B, I'll put variable cost. That will be 10,000 units into 380. If I'm not wrong, it will be 38 lakhs. Okay. So what is the contribution that you get over here? 2 lakhs. They have told you have some additional cost also coming in. How much is the additional cost they have told? Is it 20,000? Now tell me, what is the profit that you make over here? Your profit is going to be 1,80,000. From this, we have to minus the opportunity cost. This is the challenging area over here. And I can find out the profit after considering opportunity cost. All right. I'll give you a minute's time. Please scribble down till here in your books. Hold on. Is there a bad debt that I have forgotten? Oh, yes, there is a non-recovery of 2% of the bill, which I have not considered, friends. So 20,000 plus on 40 lakh, 2% will not be recovered. How much is that turning out to be? I think that is another 80,000. So your profit will now turn out to be how much? It will be only 1 lakh. Fine. So now our biggest challenge is to find out the opportunity cost. So friends, what happens is here in this example, ideally for selling this 48,000, what is the cost that is involved? 38 lakh of purchase I have to do, another 20,000. So total my cost turns out to be 38 lakh 20,000. From this 38 lakh 20,000, they have told 20% of the bill. How much is 20% of 38 lakh 20? 7 lakh 64,000. This money I will get only after how many days? After 30 days. So for this 30 days, I will have to pay interest from my hands. How much is the interest they have told? 18%. So this into 18% into 30 divided by 365. That is the first scenario. How much do you get? Do I get the answer as 11,303? 1 minute. 7,64,000 into 18% into 30 divided by 360, not 365. 11,460. All right. That is the first 20%. What about the next one at the end of 60 days? Another 30%. How much is 30% of 38 lakh 20? Is it 11 lakh 46,000? Into 18% into this will be 60 divided by 360. That is 34,380. All right. Point number 3. Third one is what? Down they have told 90 days, again 30%. That is 11 lakh 46,000. 18% into 90 divided by 3%. 51,570 will come, correct? And what about the last one? 18% of the bill. That is 38 lakh 20 into 18 percentage. 6,87,600. How many days is that? 100 days, correct? 100 by 360. 34,380. All right. I think everybody is clear so far. Perfect. Now let me add up all these numbers and see what is the total that we will get. 11,460 plus 34,380 plus 51,570 plus 34,380. Do I get the total as 1,31,790? So this is my interest cost, or you can call it as an opportunity cost. So this much money I have to pay if I have to sell him goods like this. So I'll put that over here, 1,31,790. So now tell me, after reducing this, I make a loss of 31,790. So should I sell the goods to him? Don't sell at this credit, as it results in a loss. So friends, I'm done with this question, and with this question we are done with RTP November 23. I hope this was understandable to all of you friends. Now what I will do is I will share with you this entire solution so that you can use it as a reference and you can revise it yourself. Just the way we did RTP today, friends, tomorrow we will be doing what? MTP. So like that, we will do MTPs also. And once we are done with RTP and MTP, we'll be covering a lot of questions which can be expected for the upcoming examination. Okay, so 1 minute. Let me just save this file. Please bear with me because I want to confirm that you get the file right away now. Once I pack up my session, then I will be busy with my own activities. You will be busy with your own activities. Inter Fm Rtp Yes, so file is getting saved. Give me a moment. Okay. Yes, so I think I'm done with this. I'll just share it with all of you. Now I'm putting it in the WhatsApp group, okay? In which done, friends. Please confirm that you have got it. Once it's confirmed, I will, close it. I believe you're all there in the WhatsApp group. Do you want the WhatsApp group to be sent here? Got it, right? Perfect, perfect. All right. All right, friends. Thank you so much. I'll see you tomorrow night at 9 o'clock. So, like that, tomorrow, day after tomorrow, hopefully by Wednesday, we will pack up with MTPs also. So that as a team, we can score very good marks in the upcoming exam. And whatever doubts you have, you can ask me over here. Just one more moment. Anjana, are you there live? You had a doubt, right? I think she has left. Okay, I'll message her. Thank you. Thank you so much, friends. Take care. Have a nice time. Good night.